Hey, good morning, everyone. Marty Mazzora here. Friday, the 14th of April, 2023, with your end of week market snapshot. I will be following up later this evening or over the weekend with your economic update, which is going to be interesting. We had retail sales out today. I'm going to want to talk about that and just other data during the week that pretty much confirms our current outlook on the economy. Of course, the economy and the markets are two different things that I think ultimately converge, and there's definitely some divergence here of late. So today we're going to talk about the stock market. We'll be looking at the S&P 500 and the NASDAQ 100. Then I want to also update you on the dollar chart and on the gold chart. In front of you is the one-year daily chart of the S&P 500. And while we had a pretty notable down day, if I can kind of see that blue candle in there midweek, the bulls are still pretty much in charge. If we keep climbing up here, this bear flag pattern is going to look better and better, and that takes us up right to the last August high. And it's going to be interesting to see if we do get there, if we can burn through these divergences along the way on the MACD and on the RSI. Now on the MACD, the moving average convergence divergence, what you're looking for, if you're looking for a sell signal, is two things, right? You're looking for a breakdown below what is now a bearish rising wedge pattern to go with this bull flag pattern, and then a rolling over of the signal here. So the white line dropping below the signal line, which is the red line here. Technically speaking, our view is that we are still in the bear market, and these are counter trend rallies that odds currently, in our view, favor ultimately rolling over and ultimately, I could say at a minimum, testing the last October low. Right now, with recession looming, our view has to be that more than likely the market will pierce those, as this October low really just represented multiple or valuation adjustment relative to a higher interest rate setup. The next leg lower in a typical bear market that occurs during a recession is the decline while inflation is coming off the boil, while interest rates are coming down, a decline that is characterized by rapidly declining corporate earnings coming from a market that was previously discounting earnings that were not reflecting recession, which is the market that we live in today. So this morning's been interesting already. We started out notably down in the NASDAQ, which I'll show you here in a minute, or I'll show you the NASDAQ 100 ETF, and slightly down in the S&P 500, despite the fact that the big banks actually reported really good earnings for the first quarter. We had this discussion internally yesterday, and we talked about the fact that the Q1 will probably be pretty good. What'll be interesting, though, are the outlooks. What will Jamie Dimon say about the go forward, Q2, Q3? And he was, from just the highlights, I haven't listened to anything that he said this morning, but I've caught a few highlights. He said, be careful, talking about a credit crunch. And I would say, well, yeah, be careful unless you're in places like, say, the commercial real estate industry, which is clearly seeing a credit crunch. Early next month, we're going to get the latest on the Senior Loan Officer Survey, and that's very, very important as an indicator about financial conditions overall. The banks benefited from very high interest rate margins this last quarter, meaning they were able to fetch quite a bit higher results on lending. And I would say for most of last quarter, they were also benefiting from being able to pay very low deposit rates. Well, that big outflow of deposits, as I'm sure many of you have noticed, has resulted in much higher deposit rates, particularly on CDs and such among the banks. So those net interest margins probably get squeezed between now and the end of the year as inflation and interest rates come down, and perhaps as banks try to protect their deposit base by maybe keeping deposit rates somewhat elevated, which is kind of the opposite of what we're used to from banks, and that is keeping lending rates elevated and deposit rates very low. Again, that's just me thinking out loud, remains to be seen. Not trying to be pessimistic here, folks, I'd like to think that we're just trying to be objective and realistic amid a market that, still kind of thinks like it did, investors in the aggregate, if you will, that, U.S. growth stocks are the place to be, that long duration tech stocks are what you want to buy when interest rates are lower, and we should be buying the dips right here because we had our bear market last year. From the very get-go, from the very beginning of the bear market, where we actually targeted 3,500 as the bear market low, with the caveat that that's where we think the market will rest. And you can go back and look at those old videos, literally called it at 3,500, with this huge caveat that if we're in recession, highly likely that we go lower than that. So I had to retract that call before we got there, because as we were getting there, our assessment was odds favor recession, probably in mid to later 2023. Therefore, stocks are going to go lower. But that's a tough narrative for Wall Street to swallow. That's a tough narrative for the politician and for sure the policymaker to swallow. It's kind of ironic that our Treasury Secretary, who was once the Fed chairperson, is pushing back aggressively against recession odds when her old staff, Fed economists, are basically saying recession's coming second half of the year. Treasury Secretary is saying, oh no, the economy is resilient, jobs are strong, and so forth. And that's the stuff that gets out there and gets folks like me, who are really digging deep into the data, a lot of pushback. And by the way, I want to acknowledge and explore all these narratives. Our job is not to be right on our narrative. Our job is to be right on investing our clients' money consistent with what we believe to be the right global risk-reward setup. You can't see my hands, but every client meeting, I hold my left hand up in the air and I say, this is where stocks are currently valued in our estimation. And then I hold my right hand, as much as 10 inches to a foot below that, and that sounds like a lot, but it doesn't look quite that much, say 8 or 10 inches below that, and I say, this is where we see conditions. So we think right now that probabilities favor the left hand, stock prices, coming down to where conditions are. But it doesn't have to happen that way. Basically, the two hands have to meet, in my metaphor, stock market and conditions, for us to add more exposure at any given time. It could actually be that the bulls are right, that conditions will come up to meet where stock valuations are. Not our base case right here, because we think recession's coming, but that could happen. And if that happens, perfect, great. We will add more risk under those circumstances. Maybe we meet somewhere in the middle. Maybe as earnings projections come down, the economy rolls over, and then interest rates really roll over with that. Well, then lower interest rates are a tailwind or a buoy for stock prices. So that's going to help from a valuation standpoint. It's just that real world earnings are going to be demanding that stock prices come down to meet that real world. So maybe it is somewhere in between. Maybe it's not 3,000 or 3,200 actually is our new target. Maybe it's 3,300, maybe it's 3,400. It's notably lower than we are right here. So we're going to continue to hedge, we're going to continue to diversify the way we are, and we're going to continue to do our best to mitigate what we think is coming, but most importantly, to invest consistent with where those two hands are right now. And that says that the risk-reward setup, in our view, just our view, is not conducive to adding more risk right here. Okay, so as for the technicals again, I got off track there a little bit. You've got this divergence, though, that becomes something actionable for a trader when we get a sell signal there. It is on the RSI. It is by definition a divergence. And notice that we're about to get to overbought territory once again. And the one time we got there decisively during this bear market was quite the whopping correction right here, right? And where did it happen? It happened with, rising wedge pattern, right? There's your sell signal. There's your correction. There's your overboughtness. There's your correction. Here, we had this double top in here, We had our sell signal hit. We got saved right in here, and things you'll recall, we were pointing to a bullish setup as we got this consolidation here. We got our nice rally, and we've been hitting our head here at around 4160 on the S&P. We hit it this morning, and we're wrestling with it right now. So yeah, on the daily chart, I sure understand where the bulls are coming from. I mean, we've got positive sloping moving averages. We've got a potential bull flag pattern. We could absolutely, with earnings, good earnings news, who knows? We could get up here to this 43.25. If I were a short-term trader, everything else being equal, I would be shorting that with both fists, so to speak. Looking at the hourly chart, we have broken out above this resistance right here that we're bumping up against. We have, you know, we can do this, you know, we can do this, or we can do this, right? Kind of have a channel going in there. Again, there's that 4160 range that we're kind of resisting right now. If you're interested, 4145 is where we sit right now, about 12 points below where this particular chart is reading. Very notable bearish divergence there. That's a divergence as well. You know, becomes official if that rolls over, which it will today if the give back that I'm looking at right here continues to evolve. On the Qs, which is the ETF that tracks the NASDAQ 100 index, notice again we're dancing along that line, 313 or so on the Qs, 320. Looks like some pretty, potentially pretty stiff resistance right in here. This says 319.70. The Qs are actually trading at 318.70 as I speak, but we're all over the place. This morning, that downdraft, I think, had a lot to do with Fed Governor Waller coming out and sounding hawkish and saying inflation is too strong, the labor market's too tight, we're going to keep raising interest rates. And that really threw the curve at the market today. But then we bounced out of that noticeably when I started talking. But right now, the major averages are in the red. Folks, this is bearish. This, other than the moving averages, this is as bearish a look for the Qs as we've had during this bear market. I mean, this was bearish enough right in here, right? This rising wedge. The reason this is as bearish, if not more bearish, is we have pretty much the same overbought levels that we're coming off of. But we didn't have here our long extended divergences in momentum. We have those here, and we actually have the sell signal on the MACD, unlike on the S&P. And the NASDAQ, you know, is very tech heavy, as is the S&P. So you could argue that NASDAQ is going to be the leader that we should keep our eyes on. So we'll see. So again, I'm coming off bearish, but like I said to you at the last video, I know people, technicians who I really respect, who think that near term there's a rush that we're going to see up to about this level right in here. And if we get that, again, all things being equal, oof. That's just going to make the fall harder if we're right about the potential. And again, folks, as I say these things, I keep hearkening back to what I said a minute ago about conditions and stocks. The reason I have this negative view and we're being careful is because I think this would be a rise in stock prices is very inconsistent with prevailing general conditions. Therefore, all things being equal, the higher we go here, I think the harder we fall. So in our last update, which we do monthly of our own equity market conditions index, I pointed to a bullish look for the dollar, which the way things are trading of late would be a bearish look for stocks. And so right off the bat, we got 3 or 4 days of a bounce. But since then, the dollar has rolled over. It's rolled over on weak economic news and the anticipation that interest rates are going to go down. But there's nothing at all different about the technical pattern here. And by the way, we're long-term bears on the dollar. It's just short-term, technically speaking, the setup is bullish, right? We have a falling wedge pattern, and we have long divergences again. We'll need that buy signal here. But I think we're probably going to get that. You notice the dollar is bouncing a bit today. In fact, it's up 42 basis points, which is a pretty big bounce as I speak, and this long divergence on the RSI. So people are pretty short-term bearish on the dollar, and I'm long-term bearish the dollar. Technically speaking, short-term, this looks like a bullish pattern to me. And if it plays out, things are going to get dicey for stocks here in the near term. And then lastly, looking at gold, recall that I've been pointing to what is, a pretty bearish technical setup. I can kind of redraw our rising wedge here, but we still have a rising wedge. Looked pretty smart here, right in here when we were looking at it from this angle. And again, at that point we had a bearish divergence, but no sell signal. Today gold is down 1.5%. So that's about to happen. And that could see somewhat of a precipitous drop in gold. And again, folks, you know that we are not small in gold in our core portfolio. And I'm not changing that based on this look right here. But if the dollar goes up and fear about higher interest rates continues, then you're going to see gold come off the boil. Long term, we think there are a number of reasons to be bullish gold going forward. And folks, and we added gold in December 2019. Prior to that, we really didn't have a position since 1999. So we're not gold bugs. Obviously, we have a thesis now going forward that we have a high level of confidence with, that is going to inspire us to own gold probably for quite some time, as well as silver, and by the way, as well as copper, and as well as ag commodities, and as well as Brazilian equities and Mexican equities. And clients, you know the theme that I'm talking about, because we talk about that in our review meetings. So interesting setup right there. The market seems to want to buy the dips. Since I've been talking, we've gone from positive about 40 basis points on the S&P to negative 26, positive probably about that on the QQQ to negative 50 basis points. So market may be rolling over a little bit today, but folks, you've noticed that this, at least the equity market, is topsy-turvy as can be. Certainly gold is discounting what we think the short term looks like, and equities are starting to move in that direction as well. Interestingly, bonds are down quite a bit. Our long-term treasury bonds are down 0.2% today. And that would reflect probably inflation worries. For the most part, bonds of late have actually been reflecting more of our recession concerns. So again, lots of movement. A lot of it has to do with flow. I told you last week that we had a huge amount of short interest in the S&P 500 among speculators, multi-year short interest. I think yesterday's big move was, I'm sure to no small degree, was some of those panicky shorts, reacting to a spike higher. I said that in the video. We get a spike up, those shorts cover, and you can get something quite special to the upside. Well, we got that yesterday. Looks like right now, anyway, that's being faded. So, folks, I will leave it there. You're going to hear from me shortly, either today or over the weekend, with our economic update. Hope you have a great rest of the day. Thank you, as always, for watching and listening. Take care. Bye-bye.